This was crypto's worst week since the summer of 2024. And here's the part that matters. It didn't happen because of one bad headline. It happened because the people who had been buying simply stopped. And one of the biggest started selling. Start with Bitcoin, because everything else moved in its shadow. Bitcoin opened the week trading near $74,000. By Tuesday, it had slipped under $70,000. By Wednesday, under $67,000. And by Friday, it touched around $60,000, its weakest level since October of 2024, before clawing back towards $63,000 by Friday evening. Top to bottom, that's a drop of roughly 15% in a single week. The pain wasn't gentle. Across the slide, total liquidations hit about $4.47 billion, and roughly 93% of that was bullish bets getting wiped out. This was a market position for up that got hit with down. So what actually drained the bid? It wasn't one thing. First, the largest corporate holder turned seller. Strategy, Michael Saylor's company, the single biggest corporate Bitcoin buyer of the last several years, booked its first Bitcoin sale in 4 years. When the buyer everyone counts on to absorb dips becomes a seller, the floor feels a lot further away. Next, the ETFs. Spot Bitcoin ETF investors headed for the exits, and the redemptions mounted all week. One precision note, because it matters. ETF outflows don't mean BlackRock decided Bitcoin is going down. Redemptions are shareholder-driven. Investors pull money out, and the fund hands back the proportional Bitcoin to meet it. But the effect on the tape is the same, a steady stream of supply hitting the market with thinner demand to meet it. Then there's the thread we've been pulling on for weeks, the AI trade. Saylor, Mati Greenspan, and Jameson Lopp all pointed at the same culprit: capital rotating out of crypto and into the AI boom. We said it after the last leg down, and it held up again this week. Bitcoin isn't crashing so much as it's getting outbid for the same risk dollars. And the macro spark that lit the fuse on Friday, a blowout U.S. jobs report flipped the rate conversation from cuts are coming to hikes might be back on the table. And crypto, the highest octane risk asset on the board, felt it first. That's the macro beat. Now back to the part that's actually crypto. Because underneath Bitcoin, the real carnage was in one specific corner: privacy coins. Zcash detonated. An AI model surfaced a critical flaw in Zcash's orchard pool, a forgery vulnerability that had gone undetected for 4 years, forcing an emergency hard fork. ZC collapsed more than 30%, bearish bets hit a record, and Arthur Hayes publicly dumped his position. The damage rippled straight through the rest of the privacy trade. Monero, Dash, Decred, all bled. Privacy had been one of the hottest run-up narratives heading into this week. By the end of it, that narrative had a 4-year-old bug attached to it. The other casualty, this cycle's recent winners. Hyperliquid's token gave back around 15%. Near and Venice token, the AI play, gave back 10 to 20% each. When risk comes off, the trades that ran the furthest fall the hardest. And Ethereum quietly slid under $1,800, which has people asking an uncomfortable question about whether ETH still has a story the market wants to buy. Now, here's the twist, and it's worth sitting with. While prices were getting torched, the plumbing never stopped getting built. This week alone, JP Morgan, Bank of America, and Citi announced plans for a shared tokenized network to defend their deposits against stablecoins. BlackRock-backed Securitize cleared a key hurdle to go public on the New York Stock Exchange. Grayscale launched a hyperliquid staking ETF, kicking off a 3-way fee war for that product. And the first Fannie Mae-backed mortgage using Bitcoin as collateral actually closed. Price and adoption pointed in opposite directions this week, and over a long enough horizon, that gap is the whole game. So where does that leave us going into next week? Watch whether $60,000 holds as a floor or becomes a ceiling. Watch the ETF flows. If institutions stop selling, that's your first real all clear. And watch the Fed, because after Friday's jobs number, the rate path just got a lot more interesting. For 1 week, the story was simple. Bull markets run on who's still willing to buy. This week, the buyers blinked. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.